going. It's going to prompt you to record really quick. And yeah, thanks for coming. We're going to get started. My name is AZ, and this is Investing A to Z with AZ. Kind of a handful, but still a really cool title. I know investing has been kind of a hot topic as of recent because of the whole GameStop thing and the whole buzz around cryptocurrency. So I'm glad to be talking about investing today, mostly about the general principles and some things that carry over from all aspects of investing. So this is a really comprehensive presentation on some general things to help you get started, as well as just more information help you dive deeper into the world of investing. So my name's AZ. Like I said, again, I am from Sac State Financial Wellness. I've been with them for over a year now. Super exciting. We help students with personal finance in a number of ways, right? We have these cool workshops and presentations where we could talk about budgeting, investing, loans, and a bunch of varying financial wellness topics. We have one-on-one sessions. So if you do want to talk about investing at a little bit more of a granular level, then you can make an hour session with me and then we could talk about that. I would love to do that. I think our contact information is at the end of the presentation. So we'll get that in there so you can make an appointment if you want to. So the 4 topics we're going to be talking about are why you should invest, investing basics, and then an introduction to investment vehicles, risk, and diversification. Some first steps. So before you begin investing, I think it's really important to look at your personal finance as a whole, as an individual, right? So once we understand how much income we're making, how much our expenses are, so what our bills look like from month-to-month basis, then we could really understand how much we can contribute to be able to invest, right? So building an emergency fund is a big part of that. So that's 3 to 6 months of expenses. And another first step is to consider your investing goals. So when we're talking about considering our investing goals, that's our short-term goals of, okay, how much from a month-to-month basis do I want to be able to contribute to my investing portfolio? That's more of a short-term goal, right? But then we look at our investing goals in a long-term perspective. We're thinking, okay, in 30 years or by the time I'm 59 or 60, I want to have XYZ amount in my portfolio so that I can retire happily. So understanding what our short-term goals are and what our long-term goals are really important, even if our long-term goals seem super, super far away. And as college students, I think it's really important to remember that a little bit when we're investing goes a long way. So I understand that a lot of students aren't necessarily flooding with cash, right? So it's important to understand that as long as we're contributing small amounts, a lot over time, then that's going to add up and that's going to compound. So remembering that a little bit goes a long way is really important. And talking more about financial wellness and personal finance and budgeting and how that ties into investing, I think this is a really cool TikTok to give you some perspective on how personal finance and investing are so interconnected. And a lot of students don't really think about it like that. They think of investing kind of like, I'm going to start with investing and then I'll become financially well because I have all this money that I've made from investing. But they're really two things that really should be connected. And you can't really invest well and invest, with good intentions and good practices without being financially well and managing your money well. So here's a cool TikTok. I found this one. It's really cool.
Did you know the average meal out costs approximately $15? Whereas the average meal prepared at home will only cost you $5. 15 minus $5, that's $10 saved per meal. Now, if you just invested that $10 you saved at a 10% return on investment for 40 years, you would have, wait for it, $1.6 million. Click that plus for more money tips.
Right. So obviously, we're not going to just think about that every single day. When you save $10, then we're going to try to invest that, right? So he's making an exaggeration in the sense that if we save money from our budget and we're able to save money, understanding that if we cut out different types of expenses, then we could add more money to our portfolio. I think that's something as a general principle that we should all keep in the back of our head if we do want to get into investing, is that similar to when we want to adjust our budget to cut down on different expenses so that we can pay for things that we want. Like, let's say we're saving up for a new computer. We might spend a little bit less on takeout and coffee to try to add more into savings. You treat that the same way with investing. If you want to start investing a little bit higher of an amount from a month-to-month basis, then you might want to cut out different expenses and then allocate more money to investing. So I think that's a really cool example of how financial wellness and investing is so connected. Got to be investing on a budget.
Did you?
All right, so this is what a spending plan looks like, right? You pay yourself first, get some money in your savings. And like I mentioned before you start investing, building an emergency fund of 3 to 6 months of expenses is really important, right? Once we have our savings set up and we pay ourselves first, we have an emergency fund, then we're looking at our expenses in terms of needs and wants. So we have rent, car insurance, groceries, gas, coffee, and takeout for our expenses. And I wanted to put this here to show you that before you start investing, a spending plan or budget is really important. And if you don't have one of those already, then you can, like I said, plugging our services at the beginning, I could actually sit down with you and we can make a budget together. But this also brings up another cool point of why a spending plan is so important, right? When we want to start investing, I think setting a big goal amount for initial, almost like a down payment, right? You'd think about when you're thinking about buying big things. You can start small with an investment portfolio, but a common practice is to save up some cash. Maybe it's like $1,000 in cash or $1,500 in cash. Save up that $1,000 or $1,500. So you have your emergency fund first. Then we start saving up for the beginning of our investment portfolio. So if our initial deposit is $1,000, then that'll be a really good starting amount to have a nice size portfolio. And then from there, it's okay, every single month, instead of paying myself first towards my savings, I already have my emergency fund set up. I have my initial deposit for when I want to open an investment account, that $1,000 that I've saved up. Okay, now every single month, instead of putting $190 into my savings, I'm going to use that $190 to invest, right? So now we've set up a good foundation because we have savings. We have that big money deposit to start our portfolio. And then now we know on a month-to-month basis how much we can afford to invest. So I think that's a really good strategy. It might take some time to save up that cash if we have a lot of expenses, but I think it's definitely worth that. And we don't have to start with a big goal of 1,000 to start investing, right? Could be 500, could be 300. Really up to you and how you see your spending plan and how investing can fit into your spending plan. So transitioning from budgeting, we're going to be talking about why investing is important, right? So this is a concept that is, you notice it on a daily basis or like a yearly basis, but you don't really think about it like it's affecting you in some big way, right? So the time value of money, your money today will likely buy less tomorrow. So in this, you see that in 1913, a quart of milk was 9 cents. So you could buy a lot of milk for 9 cents. With through some ratios in 1963, one small glass of milk is that 9 cents. And then 2017, for 9 cents, you're only getting 7 tablespoons of milk, right? So the value of money is decreasing over time, 1913, 1963, all the way to 2017, right? So investing is something that helps us protect the value of our dollar. So that is really the biggest reason why you should invest instead of saving all that money as cash or any type of savings account that will not give you as much return as investing. And the proper term of the increase in price levels and fall of purchasing power is inflation. And that's what we're trying to beat from a year-to-year basis when we start investing our money. So as a more common example, in the year 2000, using the milk example again, there is a 200% increase in the price of milk. You see this in every single item that you go to the grocery store, and even with gas, right? So gas used to be so cheap, and then with inflation, those prices are constantly rising over time. In this example, in 2000, a gallon of milk was $1.50. And then 2018, we're looking at a 200% increase to $3.50, right? So that was over a span of 18 years. So you can only imagine how high our gallon of milk is going to be in 2021 or 2029, 2030, so on and so forth. Inflation is going to continually be a thing that is affecting your money. So it's important to understand what types of vehicles or what types of things we can invest in that can protect our money from inflation and give us the returns that we want to be able to be more comfortable when we retire, to be more comfortable on a day-to-day basis, to be able to buy some of the things you want to buy without having to save for a long time. Sometimes investments can be a good vehicle for that as well. So talking about savings accounts and interest, it's important to understand that though these are really good places to have your money accessible, right? So if you want to put money in your savings accounts for emergencies, like I said, that money is pretty easily pulled out of your savings account and then transferred to your checking. But these aren't really necessarily the best places for where you want your money to grow. If you're not touching money and you're not touching your cash for you're not going to touch it for 10, 20 years, it's just there for you, then you want to put it in a place that's growing a lot of interest. And when we talked about inflation from the previous slides, inflation from a year-to-year basis is like 2 to 3%. So when we look at these big banks that offer savings accounts that some of you might be banking with, you have to understand that the APY, or the average percentage, annual percentage yield for these bank accounts and these savings accounts are not even meeting close to 1%, right? So when we're looking at these savings accounts, not saying you shouldn't use one, I use one, they're very good tools, but understand that they're not the best place to keep your money if you do want to invest it, right? So comparing that to some high interest savings accounts, putting this here because a lot of students don't know that these are an option. If you want to have something more with higher interest for your emergency fund, for example, where you don't necessarily know when you're going to use your emergency fund. So putting your emergency fund in something like a high interest savings account versus a regular savings account is a really good alternative. Though these are closer to 1% and they're not very high, they're going to be a lot higher than the 0.01% that we saw from the previous slide. So understand that if we have our emergency fund in a place where it's getting a higher yields and higher interest on our savings accounts, then that's going to be better for us if we're going to let that money sit for a period of time where we don't necessarily know when emergency is going to happen. It might be in a year, it might be in 6 months, right? So emergency fund is there, but putting in a high yield savings account is definitely a really good idea. So talking about investing and keeping it simple, there are a bunch of topics that people want to throw around with investing. And I think today I really just want to keep it simple and really want to talk about the generals and basics, right? When we're talking about diversification a little bit later on, there are so many different ways to diversify. But the one thing I want to urge you when you start getting into investing and you start getting into the weed works, when people are talking about options trading and like day trading or buying cryptocurrencies, I think a general principle that I would like to lay upon you is just to keep it simple. But if you do want to venture into those things, then educating yourself about them is the most important step, right? I'm not telling you not to diversify your portfolio. I'm not telling you not to buy Pokemon cards and try to sell those as an investment or hold on to those as investment. Definitely do that, but understand that you have to research and understand what you're investing in the first place before you take on a bunch of risk and purchase a bunch of different assets that you don't really have any idea about. So the general rule is when you're investing, keep it simple and keep it to what you know. So now when you're talking about something that is really cool, Albert Einstein, smart person, called compounding interest the eighth wonder of the world, straight up. So time is definitely a friend when it comes to investing. Like most things, when it comes to personal finance, time is really going to be your friend. So starting earlier is going to be the most beneficial. So if we take our 5,000 initial deposit, that might be a little high for college students, but this is just an example to show you how interest on interest, aka compound interest, helps your money grow. So if we have a $5,000 initial deposit, so we put $5,000 into an investment account and then $100 monthly contribution. So from January to December, we're investing $100 with an 8% estimated rate of return. I use 8% because if you're investing in, I think the the S&P 500. So the 500 top companies in the United States, if you invested in S&P 500, that grows 8% every single year. So I use that 8% of return, not randomly. That's a typical return from the stock market. So year one, we put in that 5,000 and we're doing that $100 monthly contribution. By year 10, our money has grown by $46,280. So if you started when you're 20, by the time you're 30, your portfolio is really, really big now, like 5,000 all the way to 46,000. And then year 20, 121,000. And then the big one, by year 40, by the time you're at retirement age, 59, 60 area, then look at that portfolio, right? Look at how much that interest has grown from that initial $5,000 deposit. And what that really is showing is how setting up a plan in terms of, okay, I started with 5,000. I want to make at least $100 monthly contributions. And that's someone who's not even changing their monthly contribution, is getting this return of $472,000, right? That's not taking into consideration after I get out of college, I could maybe start doing monthly contributions of 500, 600, 700, maybe even 1,000 every month. And then there's different types of investment opportunities that come with working, right? Like 401k contributions and all that cool stuff that we can talk about at a different time. But understanding that just having $100 monthly contributions with a $5,000 initial deposit, over time, those contributions really add up, and that interest is your friend, right? Interest on interest. By year 40, you're at $472,000, almost $500,000. So really cool example of how compound interest works. Okay, what is the stock market? So this is just a very simple definition talking about what the stock market is, right? Stocks are fractional ownerships of a corporation. So a company that entitles you to a proportion of their assets and profits. So basically, if you have a stock in XYZ company and they're doing good, then your stock is doing good. Your ownership of that company is also doing good. Therefore, you're making a lot more money if that company is doing good. So just to get that out of the way and understand what the definition of the stock market as well as stocks. Okay, so brokers. Brokers are basically companies or financial institutions that are making transactions on your behalf. So when we are talking about brokerages, you have probably seen some of these names before. These brokerages are the places, and most of the time they're online. You usually never go into a physical brokerage and ask them to execute trades for you. It's not like the 1920s or whatever. But basically, yeah, you access some of these brokerages online, and then you're able to buy stocks, buy different assets. Like I think some of these brokerages can allow you to buy cryptocurrency as well if you want to research into that. Understanding which brokerage fits your needs the best, right? Some of them are geared towards beginning investors. So look up which ones are geared towards beginning investors, understand how they're charging you in terms of, okay, this one is commission-free trading. So they're not taking any commissions, but they are charging me every time I buy a stock. So if I buy a stock of Disney, they're charging me like $2.99 on top of the price that I have to pay for that stock. Understand that fee, understand how that works. And there's also, transaction-free trading where, okay, I could buy Apple at the same price that I see it on the screen. I don't have to pay anything else, but at the end of the month, then my brokerage will be taking a certain percentage of how much money I'm making. So understand which one is better for your situation and then see which one you want to use. There are so many different brokerages to talk about and go over with their pros and cons. So going into a little bit more detail for yourself, just looking at the pros and cons of each is very important. So this is the New York Stock Exchange. Probably doesn't look like this, after COVID, but I like to show this picture to show that when you buy a stock and you execute something with your brokerage, this is actually the real physical place that these trades are happening on these computers in New York. I think it's really cool to understand that people are making these trades and there's a whole army of people at the New York Exchange handling transactions. And I think it gets really messy and stuff, but I think it's cool to know that This is what's happening behind the scenes. So they open at 6 a.m. or 9 a.m. Eastern Standard Time. So, if we're on Pacific Standard Time and we want to get to the market at open, we have to wake up a little early, like 5:30 or 5 a.m. to gather some info and then make trades if we're into that, right? So understand that we're at a little bit of a disadvantage in terms of sleep when we're trading at market open at 9 a.m. in New York. Okay, so this is a little bit of an interactive portion of the presentation. I think it's really fun and it teaches a good concept of just basic stock trading that is really cool. So let's play a game. What if Apple's value tanked because of their devices started playing Morgan Freeman soundbites? So your iPhone just starts screaming in Morgan Freeman. Really extreme example, I know, but this is it's going somewhere, trust me. So you buy Apple at $121, but after Morgan Freeman is screaming in your phone, then the Apple price drops to 75. So this is the big question. Do you keep, sell, or buy more? Prices and scenario are fictitious, of course. Keep, sell, or buy more. If you could just drop that in the chat. Buy. Courtney says buy. Okay. Yeah, definitely. So thinking about this scenario, I know I had like a group chat in high school when I was really into trading frequently, almost every day I would trade. And the name of our group chat was Buy the Dip. So we would wait for all these companies that were known to be good companies, have good valuations, have good earnings every single year, and just understand that they're really good companies that are never going to lose money or just always do well every single year. Every time they would dip below a certain price, so then in the group chat, we would spam like buy, 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 buy. And then it would just be this thing where when a company announces something, it causes like this big reaction most time. And that's usually how like stock markets like plummet and like prices are always like volatile. They're constantly changing because of different things that sway the market. No one really understands like how or why things happen, right? But if Morgan Freeman soundbites start playing out of an iPhone, definitely can't be a good thing. So that would definitely make the stock price fall, and it would be a really good time to buy, right? Obviously, if we don't have the money to buy, then keeping is also a very good thing to do. But in terms of selling, we don't want to sell when we've lost money. So we wouldn't want to sell at $75 if we bought Apple at $121. So cool stuff. All right. Before I go any further, I think I forgot to do a disclaimer at the beginning of the presentation, right? So like I said, we're talking about general principles here, but I'm definitely not an expert at investing, not even close to that. So just a mid-presentation disclaimer that I'm not an expert. We're talking about general principles here. So keep that in mind. All right. Limit order. So this is setting the maximum or minimum price at which you're willing to buy or sell, right? So an example of this is if I wanted to buy Apple. So in the last slide, it was at $121.26. Let's say I wanted to limit that order. So I would only buy Apple if that price got lower than $115. So anything lower than $115, then my trade would execute. And then I would have one share of Apple at 114 or 114.17 or 114.99. You get the point. So that's what a limit order allows you to do. It allows you to kind of play with how prices are fluctuating in the market and trying to buy at a lower point so then you can sell at a higher point. That's what people are typically doing to do buy limit orders. You could also do that for when you're selling, and the next slide will show a good example of how that is. And a market order is just basically when you want to buy a share of a company, you want to buy a stock, you want to buy a share of a company, and you just want to get that stock as soon as possible, right? Because if we're doing limit orders, then you have to wait for the market to kind of fluctuate around the price that you're willing to buy or sell. With a market order, you are selling and buying as quickly as possible and as quickly as that trade can execute over in New York. So that's the difference between a limit order and a market order. So a better example to show the difference here, we have that market order. When you buy some juice, the juice costs $5, you get your juice, right? On the other hand, when we have the limit orders, buy some juice, if it's less than $4, the juice costs $5, you're not going to buy that because you have a limit, right? So really good example of the buy market order versus the buy limit order. And then when we're selling, it's quite the opposite, right? So we want to sell at a higher price. You want to sell only if that juice costs more than $7. You know, that's an example using juice, but that's usually how it goes. If you're using a limit order to sell, usually you do that where it's like you want to sell at a certain price so you make good money from where you have purchased the stock. So keep that in mind in terms of when I actually buy a stock, I'm going to have to understand what these two types of orders are. Do I want to do a market order or do I want to do a limit order? Most of the time, just to keep it fast and simple, most brokerages just recommend that you do a market order because it takes less time. But if you're really stingy on what price you want to buy a certain stock, then limit orders are a very good option. All right, just breaking down one of the misconceptions about investing is the saying investing is risky, right? So sometimes people will share their experiences with investing to you and then tell you that it's risky because something happened in their lives and they're like, investing is risky. I don't want you to invest. You shouldn't. I lost so much money trying to invest. But when we're talking about risk, investing is risky, but so is putting money under your mattress and just saving it all, right? So like I mentioned earlier, when we were talking about inflation, investing is really a tool to help you beat inflation and to help you make your money work for you and really have that money there to beat the rate of inflation, right? If we're just putting all of our money under our mattress or under our couch and just saving our cash, right? That money by the end of how many years you've been saving under your cash has gained no interest and has lost the purchasing power. It's lost its value because you're not empowering that money to grow. And that's the biggest reason why people should invest. And if you're not doing anything with your money, that actually might be more risky than investing, right? So keep that in mind. You have to really find a balance that works for you when it comes to investing. Obviously, you don't want to go out there and gamble your money by throwing money into investments you have no idea about. But at the same time, you want to make smart, simple investing decisions that can help set you up for a good, successful retirement, a good, successful life, right? So just speaking on that a little bit more, being that kid. So there is a Stanford study. I think everyone has seen that Marshmallow Experiment video where the kids are just like eating the marshmallows and it's like super funny and cute. But the whole point of that experiment, there's like a backstory, right? So the original experiment happened at Stanford University. There was 12 kids in this experiment. Sounds weird or whatever, but yeah. So Stanford did a study with like 12 kids or so, and they did the marshmallow experiment that you saw in that YouTube video. They put out a marshmallow. The kid didn't eat the marshmallow, then he'd get 2 marshmallows. If they didn't, then they wouldn't get a second marshmallow. And that showed delayed gratification, being able to slow how satisfied you are, or slow your gratification to wait for something else to come in the future, something better, that second marshmallow. So they actually did an experiment where they did the marshmallow experiment and then they followed all of the kids from the experiment later on in life and then just kind of checked in every single year to see how they were doing. And it showed that the students that didn't eat that first marshmallow and got 2 marshmallows, and the students that were able to delay their gratification actually became more financially successful in life. They got better jobs, they managed their money better, they made a bunch of better decisions with their money and with their careers and et cetera. But it really shows that you should be that kid when it comes to investing. Don't just jump at every opportunity where you can make some money here and some money there. You really got to play the long game and delay some gratification when it comes to investing. Money might look good in your portfolio right there, but you have to think about that example that I was talking about earlier with compound interest, right? You want that $500,000 in 40 years instead of just picking and choosing when you can take out your portfolio. And obviously, there are certain situations where you have to, like emergencies and things of that nature. But understanding that there's like a pot of gold at the end of the rainbow, I think that's a good example when it comes to investing, and understanding that sometimes waiting is much better than constantly looking at your portfolio and just like, I want to take it out. It looks so cool. The market's up today. Let me take more money out. Now, there's a bunch of different reasons why. Sometimes I don't like looking at my investing apps to see how much money I've made that day, because sometimes it does hurt seeing some money in portfolio and thinking like, dang, I can't take that out. That's for my long-term goals. And so it really ties back to what are your short-term goals and long-term goals. And I think that'll help you when you see some money in your portfolio that you want to take out, but you really shouldn't. So keep that in mind. So now we're going to be talking about something that's really important when it comes to investing, and it's diversification. So diversification allows you to minimize risk while attempting to maximize returns. And in the next slide, I'll give a really good example of what diversification might look like in terms of different types of stocks and companies, right? So we have Gap, American Eagle, and then Levi's. So as everyone knows, these are retail companies that work in clothes and like textiles and stuff like that, right? So let's say something happens with the textile industry or with the retail industry for clothing. Let's say like they, I don't know, they lost all their pants for some reason. Like there's a shortage, national shortage in pants. So Gap is going to be affected by this national shortage in pants. So is American Eagle. And yeah, you guessed it. So is Levi's. So when we look at these three companies' stock prices together after this situation, then boom, our $1,000 investing in Gap, American Eagle, and Levi's is now at $310 because we invested in all of the same thing, basically, all of the same type of company. Gap, American Eagle, and Levi's, these are all retail stores. We thought those were the winner, right? We thought, okay, I work in retail, I'm only investing in retail. And you see where that gets you, right? All of them are going to be affected by the same thing. When we're looking at what diversification might look like in the sense of different companies, let's say we invest in Gap because we really like Gap, but then that goes down because of the national pant shortage. Okay, let's invest in Uber. That's not going to be affected by a national pet or pant shortage, right? And then Target. That might, but not as much, right? Even if Gap goes down because of that pant shortage, we still have Uber and Target. So diversifying actually made us some money and kept our money, right? So diversification is so broad in the sense that you could diversify the different types of stocks that you buy, right? You can buy stocks, you can have like crypto, you could have Pokemon cards, and that's all forms of diversification because we're not buying the same type of asset or the same type of stock in the same type of industry. So this is another just general principle to show you how diversification is a good thing. And I think there's like a Warren Buffett quote, who's a really famous investor. He was on the presentation earlier. He's the cool guy in the old guy in the cool glasses, but he's like, don't put all your eggs in one basket. That's pretty much a general principle for investing, right? You don't want to just invest all of your stuff into one thing, because if one negative thing happens, then all your money is down the drain, right? So keep that in mind. So to further learn how to diversify, we're going to be talking about investment vehicles and different types of assets. So obviously there are a lot more types of things that you can invest in, and I mentioned some of them, but today I'm going to be talking about some of the traditional things that people have invested in the past like 100 years. And there are new things that are surfacing as different types of investments, but I want to talk about these ones in specific. We have stocks, bonds, index funds, and then exchange traded funds, or ETFs is what they're more commonly known as. Stocks. So we mentioned them earlier. These are pieces of a company, and you can buy these on the stock market. Stocks are very reliable. People have been buying stocks for quite some time. There used to be this thing where you used to get a little certificate for every stock that you have. Now that things are a lot more digital and more accessible, it's never been easier to buy a stock. And I think people have seen that with the whole GameStop thing. People who have never invested in their life have downloaded Robinhood and then bought GameStop or AMC because they're riding the hype train. And that was it was a cool thing for me to see, at least. Not that buying GameStop was a good investment, but it was cool to see how accessible investing has become for a lot of people. It used to be a lot harder to invest. You used to have to get like a financial advisor, and it'd be a whole thing, right? But if you have a couple of bucks in your bank account, there are people downloading different apps to invest for the very first time in their life with like 15 bucks in their bank account. So stocks have never been easier to buy, and it's a really good place to start. So the next thing we're going to be talking about are bonds. And these are basically a receipt given by a government or organization, and it works like an IOU. So these work like an IOU. These typically back in the day literally worked like a receipt or like IOU, where you'd have a bond and then the government would sell you that bond. And then like 10 years later, you'd show up and be like, hey, here's this bond, pay me back my money plus some interest, right? So bonds they can still work like that today, but you don't typically see them working like that. When people are buying bonds nowadays, they're buying bonds on the different types of brokerages that I mentioned earlier. And these brokerages are basically, they're doing the whole bond process for you, but you're investing in that bond through your brokerage in the same sense to help you diversify. So to help you buy different types of assets, and this is the different type. You buy bonds on those types of brokerages as well. So if you're wondering if you have to carry around a receipt or big thing that says you have a bond, you don't necessarily have to do that. That's what happened 10 years ago, but now we're so digitalized, even bonds are becoming digitalized. So you just buy into different bonds on your brokeraging apps, and obviously you could look up which ones are the best ones to buy, and then you still get those returns, and as you see those bonds grow in your portfolio and you get that money in. So really cool how even buying bonds has become digitalized. So how does one simply diversify, right? There are so many different types of assets to think about when it comes to stocks, right? Like how many different companies are in tech? There are so many different companies in tech. How many companies are in energy? Just think about all of these companies that are on the stock market and are public companies. But how does one simply buy different types of companies for a low of a price? And that's when we're going to be talking about our index funds and ETFs, right? So diversifying made a little bit easier. And here's another disclaimer: I'm not a pro, nor will I give you any specific advice. All right. So who would want to own shares of big companies like Amazon, Microsoft, and etc.? You can just put a little thumbs up in the chat, whatever. But I pulled these from March 8th, a while ago. Right. So we have Netflix, price of $493. That's pretty heavy on the pocket. Amazon is one that people know is notoriously expensive to buy one full share of Amazon. Microsoft, and then here's the kicker: Berkshire Hathaway. Berkshire Hathaway per one share. Warren Buffett's holdings company. If you want to buy one share of Berkshire Hathaway, you're basically buying a house. $388,000 for one share of Berkshire Hathaway. So as you can see, the problem that we have when diversifying in the companies that we want to buy is price. So one share of these 4 companies in total would be $392,000. So a huge price, and that is something that most people, I'd say like 90% of people, can't afford from year to year in terms of investing. And that's where index funds and ETFs really kick into play, and they allow you to be able to invest in those types of companies, right? We have our Netflix, Amazon, and Microsoft. So they allow you to invest in these different types of companies, as well as different types of companies, right? So those were all tech companies that we showed before: Amazon, Netflix, Microsoft, Berkshire Hathaway's not tech, whatever. But basically, right here, it shows you that when you buy an index fund and ETF, they allow you to hold a small portion of a lot of different type of companies. So that diversification aspect for a lower price, right? So we have ExxonMobil, which is an energy; Tesla, which is an energy / like automobiles; Beyond Meat, which is also an energy, right? As you can see, there's a varying type of different companies that you can buy and then have all these different companies in that one purchase of an index fund or ETF. So key here, for a lower price, right? The problem was price in the last slide, $392,000. How much do you have to pay to get an investment in all of these types of companies? So I pulled the price for this index fund. I think this is an ETF, this ETF on March 5th. And it had all those companies that I showed in that one graphic for $40, per share. So instead of paying $392,000 for one whole share of each of those big companies, you get it this low of a price because you're buying partial shares of all those different types of companies to be able to diversify for a lot lower of a price. So instead of buying one of each and saving up for that for your whole life, you can buy, partial shares of Amazon and Netflix every single month for the rest of your life, if you think about it like that. So that's what makes index funds and ETFs really, really good tools to help people diversify for a low price. So some of y'all might be asking, okay, you keep saying index funds and ETFs, but what's the difference? Okay, so we're going to be talking about their similarities first, and I briefly went over that. Index funds allow you to diversify. Index ETFs or exchange traded funds allow you to diversify. Okay, primarily group stocks by index. So index funds, when they're grouping those different types of companies together, they are typically based off of what's called an index. And indexes are basically just things that measure how different types of companies are doing. So I mentioned one earlier. We have the S&P 500. So that's an example of an index. It's a measure of how the stock market is doing in a certain sector, I guess, right? So the S&P 500 is an index fund of the 500 top companies in the United States. There's also like the Dow Jones, which is like, I think it's like 30 of the biggest or something like that. So those are an example of how stocks and different companies are grouped for index funds, whereas ETFs, they're grouped in what's called baskets, which is, a broad term, but ETFs aren't really confined to having to work with different types of index funds to group their stocks. ETFs can grab different stocks from tech, from real estate, from energy, and then just kind of combine them and then offer them forward as ETFs. And then the last major difference is that index funds trade on the stock market differently than an ETF. So when you buy a stock of Apple and then when you sell a stock of Apple, like all that stuff happens instantly. And that's how an ETF trades. So when you buy an ETF, you put in the ticker or the 4-letter symbol for which ETF you want to buy. If you do a market order, then that transaction almost happens instantly, right? And then if you want to sell it, the same thing with an ETF. For an index fund, if you buy an index fund, that transaction is like reviewed, kind of a weird thing, right? So those transactions happen at the beginning of the day and then at the end of the day for our index funds. So when you order an index fund, you might see that it might take a little bit. It might take a while for you to actually confirm and get that purchase in your portfolio. So those are the vast and major differences between index funds and ETFs. So thank you for tuning in to the presentation. There is a lot of information there, but I just want to briefly go over our services before we part ways. We have workshops like this, right? I think this is wrapping up like the month of April for our workshops. Really cool stuff. But we've had workshops on budgetings, loans, savings, and then this one about investing. When we're back on campus, we have fun events like Pay Your Piggy. As you can see, student is really focused paying that piggy, really cool. And then I mentioned throughout the presentation that we have coaching sessions. So if you want to talk about this stuff a little bit more in depth, you might be able to see my puppy. My puppy is really cute. She's right there. She's a lot bigger now and maybe even a little too big. Yeah, but anyways, yeah, we have coaching sessions on Zoom for this